What is up, everyone? Welcome back to Finance Sphere. Look, right now, the macro world is focused on one person, the new Fed chair, Kevin Warsh. Since he was a Trump appointee, many investors assumed he'd step in as a market savior, slashing rates and injecting liquidity to fuel a major rally. But following his first FOMC press conference this past June, the market took a serious beating. Instead of the dovish pivot people were praying for, Warsh leaned into a hawkish tone, catching investors off guard. But here's the bigger picture. If you look closely at the structural shifts Warsh is setting up behind the scenes, you'll see how this situation has the potential to open up a compelling contrarian opportunity. Let's cut straight to the chase. Kevin Warsh isn't a simple hawk. He's trying to redesign how the Fed operates, and he's clearly thinking several moves ahead. He's actively managing market sentiment to reshape the Fed's playbook from the ground up. Let's peel back the layers on the five major reforms he appears to be putting into motion. First is his plan to link quantitative tightening, or balance sheet reduction, directly to interest rate policy. Warsh has stated that the Fed's outsized balance sheet distorts market independence, and he intends to unwind it. If you're not familiar with the term, think of the balance sheet as the Fed's financial ledger. It tracks the bonds purchased to inject liquidity into the banking system during crises. A large balance sheet means easy money is circulating. Shrinking it, quantitative tightening, means pulling that liquidity back out. Warsh points out that the current asset mix distorts the broader economy, often favoring specific sectors like real estate. He's challenging traditional Fed groupthink, calling for a thorough audit of the current framework. Naturally, many on Wall Street panicked. Offloading treasuries and mortgage backed securities drains liquidity and pushes bond yields higher. This increases borrowing costs across the board, which naturally tightens the money supply. But here's the strategic angle. Warsh may be using the tightening effect of QT as policy cover to cut benchmark interest rates significantly down the line. Think back to how Donald Trump repeatedly pressured Chair Powell to cut rates in the past. But Powell held his ground. The market expected Warsh to slash rates on day one. So when he signaled balance sheet tightening instead, those expectations quickly faded. Investors quickly shifted to pricing in the fear that sticky inflation could force rates even higher. While he hasn't labeled his stance as loose or tight, the blueprint of his new task force offers an important clue. Warsh pointed out that monetary policy impacts the economy differently depending on the tool used. To quote him directly, that's perhaps a function of different transmission mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our balance sheet tool. But the good news, we have a task force on that too, and the balance sheet task force will be looking more at that subject. In short, if the Fed maintains tightening via the balance sheet, it gains the political cover to lower interest rates. This task force is analyzing that policy trade-off, balancing asset reductions against rate cuts to keep the system stable. Given that he was Trump's pick, this task force indicates that rate cuts are a strong possibility. Even if the net policy stance remains neutral on paper, the market tends to focus on the headline phrase, rate cuts, which is likely to quickly revive investor confidence. The second shift is replacing lagging economic indicators with real-time data. Look at the headlines. There are widespread fears over inflation and calls for more hikes because of the conflict with Iran. But Warsh views legacy metrics like CPI and PCE as backward-looking. They lag by weeks, meaning the Fed often makes policy choices based on old data. His goal is to track live market data to respond more accurately. When a real-time framework is applied, that geopolitical risk factor can actually signal a completely different outcome. Historically, geopolitical supply shocks cause an initial spike in energy. At the start of the Iran conflict, Brent crude reached $114 and WTI hit $106. However, history suggests that energy prices tend to stabilize a few months after the initial shock. That's exactly what's playing out today, with Brent adjusting towards $71 and WTI around $68. Here's how it works. While central banks may adopt a hawkish tone during a crisis, high energy prices and war-related uncertainty act as a natural economic brake. Consumer spending slows down and corporations manage costs, which naturally tightens financial conditions. Because demand softens, these temporary energy spikes rarely bleed into core wages and services. Instead, the economy cools down first. In the past, central banks sometimes over-tightened by relying on lagging data, hiking rates just as the economy was already slowing down. With a real-time data approach, the disinflationary impact of falling oil prices and a cooling economy shows up in the models immediately. This provides a clear justification against over-tightening, paving the way for a policy shift. Third, he is introducing the trimmed mean inflation metric. Warsh noted that analyzing inflation requires a more refined method than simply separating core from non-core items. His new Inflation Framework Task Force plans to focus on trimmed mean, CPI, which removes extreme outliers, the highest and lowest temporary price spikes, to average the rest. This approach filters out short-term energy shocks from the core calculation, allowing policymakers to see if inflation is broad-based or just a temporary anomaly. By focusing on this metric, Warsh signals that he is cautious about overreacting to temporary price spikes. Fourth, he is moving away from forward guidance and the traditional dot plot. Upon taking office, Warsh declined to participate in the Fed's dot plot forecast, describing it as nothing more than a scribble written with a pencil that has a big eraser. By reducing forward guidance, he may introduce some short-term market volatility, but it prevents the Fed from being boxed in by its own projections, leaving room to adjust rates as soon as data requires it. Fifth is the outlook for rising productivity and falling prices, driven by the transition into a new technological era. This integration of advanced tech is poised to significantly boost productivity and expand the supply side of the economy. Basic economics tells us that if supply increases while demand remains steady, prices drop. With significant capital flowing into new tech infrastructure, this massive supply revolution means we might actually need to worry about deflation rather than inflation. If the data confirms this long-term productivity growth, it would provide the Fed a clear framework to lower rates, even amidst geopolitical uncertainty. So, what does this policy shift mean for digital assets? The crypto market is highly sensitive to global liquidity and the path of interest rates. When the conflict with Iran flared up, the combination of rising oil prices and hawkish rhetoric caused short-term volatility and a market correction. As the effects of the war clear and energy prices normalize, the macroeconomic outlook has the potential to shift. If the market has primarily priced in the threat of higher rates, a turn toward an accommodative stance by the Fed is expected to cause investor sentiment to reverse quickly, supporting a recovery in asset valuations. Most retail investors don't closely track the structural details of balance sheet adjustments. They focus on a simple trend, whether interest rates are moving up or down. When live data points toward a rate-cutting cycle, the narrative shifts. At the same time, as digital assets align with these broader technological applications, the sector has the potential to attract renewed interest as a technology play. As the temporary noise of war clears and the real-time data era led by Kevin Warsh begins, the fundamentals of the crypto market, backed by the tailwinds of Silicon Valley tech innovation, will continue to strengthen. In this changing macro landscape, avoiding short-term panic is key. It pays to be the investor who focuses on the underlying structural changes rather than the daily headlines. If you found this macro deep dive helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss an update. Thanks for watching, and I'll see you in the next one.